So before we move into this super important relationship, let's look at the insane stock market rally happening right now. As you see, the S&P 500 has ripped back from this year's dip into a near V-shaped recovery, posting multiple record highs in recent months. Big names have sprinted too. As you see, Nvidia, for example, climbed from the $90 earlier in April 2025 toward roughly $180 in August, basically doubling. Surges like these get investors excited. However, historically, they often invite a reality check. Every bull run eventually reaches a correction. One particularly interesting example is the S&P 500 bull run during the 1990s, where such a correction did not happen. Why did the S&P 500 have such a crazy growth after this tiny correction, resembling today's situation? It's because there are few powerful factors influencing the S&P 500. It's important to mention, however, there was in fact a quick 19% correction, but nowhere near as slow and painful as others we're talking about. What we generally like to say is the trend is given by the money supply in the economy. More money in the system means more money can be spent on goods, stocks, and over time that pushes the stock market higher. The trend is obvious, but that's only one part of the equation. The Fed can not only pump liquidity into the economy, it can also lower or raise interest rates, mainly to calm inflation. The 1990s were basically a Goldilocks decade, a term for not too hot, not too cold economy. A rare sight for sure. Inflation dropped in the early years and then stayed low right through the boom. Growth was strong, earnings kept climbing, and the Fed didn't have to slam the brakes with aggressive rate hikes. Normally, when inflation spikes sharply, the S&P 500 corrects soon after. But in the 90s, that spike never came, so pullbacks were quick, not painful, and the bull run kept going. The question now is, are we heading into another Goldilocks stretch like that? Or will the usual cycle of inflation rising, Fed tightening, and markets correcting kick in again? To know that, we have to look right at the core of what drives inflation. And a key factor influencing inflation, almost like a rule, is oil, specifically the spot price of oil. Take a look at this basic mechanism. Oil surges, inflation follows in few months. And as said, inflation heavily influences the corrections of the stock market. S&P 500 depends heavily on inflation, and therefore, on oil. Given this relationship, it's also possible to forecast how will inflation develop based on current oil market movements. The reason oil is such a powerful factor is that it basically is something like a quiet engine of the global economy. It drives the cost of moving goods and powers entire industries. When its price changes sharply, the shock spreads through production and transport, which steadily pushes up the overall cost of living. The late 90s saw oil prices fall and, with a delay, inflation eased. In the early 2000s and again in 2008, oil surged and inflation soon caught up. The spike after 2021 fits the same rhythm, with inflation hitting highs not seen in decades. The chart makes the relationship visible. Oil moves first, inflation responds. We've seen that countless times on multiple occasions. Central banks can tighten credit and slow demand, but they can't produce more oil to cool prices. That's why energy shocks remain some of the hardest inflation problems to solve. And as long as oil remains a foundation of the modern economy, sudden changes in its price will keep echoing through the cost of living. What we like to say is that the long-term trend of consumer prices, the CPI index, is mainly driven by the entry of M2 money supply. As more money is being printed, that naturally leads to inflation, as there's more money to spend and producers react by lifting prices. However, oil price surges add to this effect significantly, as we're seeing throughout history. From a market's perspective, the most favorable energy setup is the United States sustaining very high domestic crude output, thereby reducing net import dependence and improving resilience to external supply disruptions. Since 2008, U.S. crude production has surged with the shale boom, and by 2018, the United States became the world's largest crude producer, a position it has generally maintained. Greater domestic output naturally strengthens energy security. In macroeconomics, an oil shock is a sudden, sizable, and unexpected change in oil prices, most often triggered by supply losses from events such as war or an embargo, which naturally transmits into inflation and growth. Historical examples include the 1973 Arab oil embargo during the Yom Kippur War, which restricted Middle East exports to the United States and others, and the 1979 Iranian Revolution, which removed a large share of Iranian production. Both episodes produced sharp price spikes and global instability. So when we come back to the stock market, we saw inflation is a super important factor when it comes to market corrections, following it shortly. And inflation itself depends on money supply injection given by central bank and also heavily on oil prices. A spike in oil price always transfers into consumer and production prices. As always, this is not financial advice or a recommendation to buy or sell. We provide you with our view and take on macro analysis with regard to the markets. Thanks for watching. This is Glenius.